Well, welcome to the home office of Eagle Financial Services here in the upstate part of New York. I'm Bill McCollum, and I'm with my partner, Jack Ditt. As being the no, okay, I'm kidding. Jack, welcome to the audience.
Yes, welcome to the downtown business district of Shreveport, Louisiana, a rising metropolis. For another edition of the Jack and Bill Show, we have a special guest with us today. I'm probably speaking too loud.
I was wondering who you were yelling at.
Okay. So this is actually Wesley Roderick. He's designed our website. He's an amazing young talent. Moved here from Charlotte a year and a half ago, and we've developed a friendship. He's really part of our family now. So he redesigned our website. If you want to check us out, if you haven't already, www.eaglefms.com. He's also our social media marketing guru. So if you like the presentation, this is our man who's done this for us. So today, we're going to have a little interview, but first we'll talk about where we are in the market so far. The S&P 500, NASDAQ, Russell, all major market indices were down pretty good, but closed down just fractionally. Or S&P was down about 1/3%. The Dow down 124, still closing above 30,179. NASDAQ was just down a fraction. Russell 2000 small cap index down about 1/3% as well. West Texas Intermediate, however, was up 1.5% to 49. Safe havens, gold down a fraction, silver down over 1% to 25.68. The yellow metal closing at 1886, and 2-10 and 30-year treasuries all the way across the board. 2-year note yielding 12/100%. The 10-year still stuck below 1% at 94 basis points, and the 30-year at 1.69. So that's got us on the year, though, for the S&P 500. I think this will be a question that we might cover. Up about 16.75%. So in spite of this pandemic that we've had so far, the market doing better than the historical norms.
Yeah. Well, I mean, I think what's interesting is because I remember in the heat of everything when really things just kind of started dominoing and closing down. I remember that for you because you were in the Bahamas at that point, helping out down there because that hurricane they got hit by, and you were down there and watching everything kind of just crumble. But I mean, it's here we are, months later down the road.
Yes, that's right. I mean, Hurricane Dorian actually killed about 3,000 people. It really didn't make the news. A lot of these were minority people, Haitians. They actually got buried in the mud down there. So I was invited by a friend and mentor to both of us, Brad, to go down there and help nail shingles on rooftops and stuff. I mean, most of the houses that remained, maybe 30% of them only remained. You could stand in the kitchen and see blue skies. So the first day I got there, though, Wesley, you're right. Get there at lunchtime and change my clothes in the car and head straight to start nailing shingles. And my phone is going ballistic because the stock market was down about 12% that day, because I think it was really kind of the first recognition that this pandemic was something really meaningful and really had a bite to it.
Yeah.
And we almost got stuck down there. I think they shut down the Bahamas about 3 days.
Yeah, you got after. Out by the skin of your teeth there.
Yeah.
I mean, so, and I don't know if you can speak to this, but considering where you were at, and I mean, not locationally, but as far as how things were coming down economically in the market, I'm sure clients going, what in the world are you going to do? And you and Bill, the individual I'm covering for, I'm not Bill, if you haven't figured that part out yet. Um, but you and Bill kept a cool head and were able to drive forward through all of this. And I mean, respectfully, I mean, you guys grew, what would you say, like as far as like growing your clients accounts and things of that nature, because you were able to help people go in instead of experiencing incredible loss, you were able to help bring people into gain, right?
Yeah, the main thing, we talked about this a little bit earlier, is the psychology of investing. When the markets go down, fear can come in,
Yeah.
and it's human nature to extrapolate. That's what you read, see, and hear in the media most recently. So if the markets were in decline, most people who get fearful just want to extrapolate it in the same direction. And we viewed this as one of the top 5 buying opportunities of our lifetime. Felt like the market was so panic stricken that it was discounting that this thing was going to last, 5 years or longer. And not to, undermine that it was it and still is a very serious pandemic. But, we felt like, we wrongly felt like it would be over in a few months.
Right.
But I do think, looking at it now, I thought things would be normalizing around Easter or May, something like that. And maybe I was just off by a year in hindsight, Wesley.
Who knows?
So, but to go back to your question, one of the things we did, there was a mutual fund that has a high beta. In other words, if a fund has a beta of 2, for example, that means that it's going to be 2 times more volatile than the S&P 500. So we bought a high beta fund that went up maybe 115% in about 4 months.
Wow.
And we actually traded out of that and went into something that's a little bit calmer and pays more income. So we did take advantage of the market downdraft, and in hindsight, I really didn't have, we didn't really have any clients get out of the market.
Yeah, and I think that's important to say as far as yours and Bill's diligence to, because you guys, I know that you guys rerouted a lot of things, and like, all right, well, if this area is kind of going, but what about this area, and then like repositioning people, and that's your guys' job.
Yeah, and that's actually what's going on with the market right now. I mean, we've got this this tug of war between COVID-19 numbers are the worst that we've seen, literally, as we speak. But at the same time, we've got vaccination news coming to the market. Moderna was approved for emergency use, and I think they're waiting FDA approval for expanded use. Actually, today, I might have that a little bit wrong, but of course, we already got that for the BioNTech Pfizer collaboration. They've gotten FDA approval. There are rapid shipments of tens of millions of at sub-zero temperatures. They have to be shipped out, and the people in nursing homes in Shreveport, I think, are going to be the first ones to get it, along with frontline healthcare workers. And I think they're actually, the healthcare workers are getting vaccinations right now, and then people who reside in long-term medical care facilities, I think around the 28th of December. So this is the tug of war, is the news that we've got a cure forthcoming, tugging against the worst numbers that we've seen so far with the cold weather.
Yeah, I mean,
yeah,
there's something about tension. Tension. I mean, without tension on a guitar, you wouldn't have a beautiful noise.
Yeah, and so then a stock market implication with that. That's a good point, Wesley. Is that when all this stuff happened, you had all these stocks like camera and video equipment, all this social media marketing stuff that you need.
Yeah.
You couldn't find cameras and tripods, Zoom equipment. I don't even know what I'm talking about. I don't know the jargon. I'm clueless about the internet. But anyway, internet stocks and things that you need to work outside of the office at home, all the technology stuff, all those kinds of stocks took off. The Nasdaq stocks, and then the things that did horribly were economically sensitive stocks. So now we're seeing a reversal there to things like what's been moving lately are stocks that move in tandem with the business cycle and healthy earnings. The market is starting to discount that. So airline stocks, casino operators, automobile
Food
manufacturers,
service industry.
the food service industry. Food and drugs are always considered defensives because people are going to use that stuff whether the economy's doing poorly or not. But
Yeah.
those are things that had held up very well, and they're still doing fine, really. So
Let's beeline to one of the questions I was asking
okay,
you. So, we in many situations, other countries have had maybe two lockdown. Not I don't want to call them lockdowns. They've had shutdowns.
yeah.
Another shutdown. So, in the event of another shutdown, if that was to happen, what would you, being a financial advisor, what would you tell someone, your own children, even, like, how to financially prepare for it? Let's hypothetically say if we were to shut down later on, like, or in the beginning part of next year, like, how they're just recovering or trying to recover, maybe not
Well,
even recover.
it really depends upon where a person is in their financial life cycle, and then how they've been impacted, to what degree they've been impacted by this pandemic. I just hung up the phone with a guy that I used to be an electronic warfare officer on B-52 bombers, and a guy that I haven't talked to in 15 years just called me, and he was an engineer for Halliburton and just got laid off. Because oil prices declined, with the belief that economic activity was curtailing dramatically, even though West Texas Intermediate closed above 49 today, and oil prices have been going back up, with the view that things are going to be improving economically next year, and people will be, using more oil. But so I would say this: if you're in that kind of a situation now, he's unemployed. Um, any kind of investments that you have that you might be needing to tap into, Wesley, they need to be invested for preservation and for income. So you don't want to be buying things like Tesla, or Apple or Netflix or Nvidia, things that are exceptionally volatile, even stocks in general. The stock market is at an all-time high right now. You don't want to be trying to speculate if you don't have a job to try to make a few more percentage points, in the next 6 months. So you should be in cash, short-term bonds, things like that to preserve your income. And so if the other thing is you don't want to try to time the markets like this with this. So
Yeah.
hey, we're about to have another shutdown. Is it gonna be like it was in March when I was in the Bahamas? No, I don't think so. I mean, I think the stock market and the bond markets are a discounting mechanism that typically look out 6 months to 12 months to 18 months. And all these smart analysts are making forecasts about their expectations about what these companies' corporate profits are going to be looking out there. And they factored in all current information or knowledge they have about the state of the markets and the pandemic and all that. So the market will be discounting, in my opinion, that things are going to be getting better pretty quickly.
Okay.
So and you have to balance that though with all the bad news. But now the other thing I think you could look at, it depends on the investment too. I mean, if you own New York City tax-free municipal bonds and they take extraordinary steps to shut down everything, I mean, there are some government officials that can do silly and stupid things Um, um, I could probably start a debate here with some. I'm not meaning to be political, but because they feel like they're doing the right thing to protect,
Yeah.
uh, the health of the people that they preside over. But in a lot of ways, in my opinion, the cure for this pandemic has been far worse than COVID-19 itself. If you look to emerging economies, there are a lot of people that have starved to death
Yeah.
with supply chain disruptions and things like that. More people have died from that than from the pandemic. So so we don't want to time the markets. The market is a discounting mechanism, and it depends. If you've kept your job, if you've been able to work in a place where the virus isn't going to impact you, if you work in a technology arena or something like that, if you work in an industry that's not deeply cyclical and you don't have any concerns and you have investments, you want to just stay the course.
Yeah.
Versus someone who could be, if you work in the restaurant business, that's a different story.
You're right. No, absolutely. I mean, or like entrepreneur or something of that nature,
Exactly.
sole proprietors. And now you were talking about, the like looking at the actual investment itself. And I know a lot of people, as far as my age demographic, and probably be 30s to 45, you know, are really looking at right now as far as like cryptocurrency and Bitcoin, because I'm since we what we're looking at is it's doubled, like. And like even you were saying, like in our discussion previously, is like, well, it would have been really good to look at it 9 months ago. But I was like, 9 months ago, we were told not to look at it. So it's kind of like, look at it, but don't look at it. And then, but like, what would you say is really like leading to this leap? Because like, it seems like it's grown significantly in the last few weeks.
Oh, absolutely. I think that a lot of these cryptocurrencies that include Bitcoin have really, really done well because of the shenanigans, you could say, or the necessity, some would say, of what the world central bankers have done. So, I was just looking in here just a minute ago that we were at like 20 or 21 rand to the US dollar, and now it's at 14. So 14 rand to $1. So the dollar has been, with this pandemic, the dollar has been weakening. The dollar has been weakening because our central bank, our Federal Reserve, has been printing money, pushed the Fed funds rate down to zero, has commented that they're leaving it there until at least January of 2024. That means if you are an elderly person that lives on a fixed income, that is not good news. If you are a borrower, if you have money and a means to borrow and speculate and you're young like you, not me, then there, with low interest rates, you've got people even borrowing money to speculate in the cryptos and so forth. But the European, Japanese, and American central bankers have, I think, in a lot of ways, been on an irresponsible path since the subprime crisis, which began in 2008. And it's generated a lot of interest in the cryptos. Now, I spoke with a gentleman yesterday that told me, he put a few $1,000s, and I think that's okay, but he was telling me that he read where someone was giving them advice that now's the time to have at least 5% of your net worth in cryptocurrencies like Bitcoin. And I'm here to tell you, I'm not going to say that. I don't even know how to buy the things. I mean, I think an alternative that has done very well this year is silver and gold, both up over 25% on the year. I think silver and gold, just a speculative guess, I think they'll probably double over the next 5 years. That'd be a return of over 15% per year. So it's not just the cryptos. I mean, it's silver and gold. These are alternative currencies to the shenanigans of the dollar, fiat currencies that have nothing backing them. US dollar, the euro, the Japanese yen, things like that. And this thing will ultimately, hopefully, years and years into the future, it's looking more and more like it could happen sooner. We will have to get away from this fiat currency and go back to an asset based system because if you study world history, think Argentina failing again recently. They failed quite a few times where they get to a debt to GDP or the national debt divided by the size of their economy. And what happens is you keep on borrowing irresponsibly, and you get to a place where the populace loses confidence in what the government's doing and the financial entities, and interest rates skyrocket because everyone sells their currency. And that is coming to the developed markets if we can't get things back on track, in a hurry.
Okay, no, that makes sense. I mean, I kind of see it as where you have. I mean, anyone who's ever looked at like in the stock market and things like that, it's a long term game. It's not a short term thing.
Exactly.
I mean, unless you're going to be a day trader, but that has its own issues.
Yeah, that's exactly right. The time to be excited about Bitcoin and the other alt currencies was back in March. I mean, now's not the time, in my view, to be, really excited. If you thought that this was a long term thing, you could nibble at it at these levels, but you'd want to use some kind of a stop loss or have a get out plan in case you're wrong.
Right. No, I get that. And so, I mean, we'll kind of go to this last question then.
Okay.
Because I feel like you answered even like the sub part of the Bitcoin question there.
Okay.
Is so talking about this, like $2,000 or how, you think about when people say, oh, I'm going into the market, I'm investing, and you usually hear something, like they're cashing out their 401k, which can be anywhere from like, depending on how long they've been at the company, $10,000, $20,000 or something of that nature. But how would someone say like an entrepreneur, someone who they get paid per project, they get paid per whatever, and so like they're piecing together their income as it is. They're a sole proprietor. And they're trying to figure out like, all right, how do I build a nest egg for myself? How do I build a future for myself? Because if you're an entrepreneur, you enjoy your freedom because you don't have someone like kind of looming over you saying like you're going to do this and you have to be here at this time and so on and so forth. But at the same time, you don't have the benefits of the same thing. So like you don't have the medical insurance, because of the employer. You don't have the 401k, the retirement plans. How would someone do that? Like if they don't have that like initial $20,000 investment or 10,000, or your friend, like to be able to put 2 grand into something like Bitcoin. I mean, 2 grand right now in Bitcoin doesn't even technically buy you a full share. It buys you like a tenth of that. So 2 grand, but I mean, so like when you think about that, that could be a lot of money for somebody. How could somebody that's maybe not in a well off position begin building?
Yeah, and that's interesting too, because at our firm, Eagle Financial is legally a caring fiduciary. It's against the law for us not to act in your best interest, and we are a fee-based advisor, and we really enjoy helping people. We have accounts here that are $1,000. We have a client that sends us $50 a month electronically.
A month, and not a week.
Actually, we have one that sends us $50 a week as well. And we have others that send us money electronically a couple times a month and monthly as well. And then we have accounts that are over $10 million in size as well. So, and we manage the monies consistently with the individual's objectives. So it comes down to the individual, what stage of their life they are in, what the money's for, what their time horizons are for, what kind of return expectations they have. Will they lay awake at night if they lose 10%? Things like this. Are they willing to speculate with some of the money? How aggressive do they want to be?
Right.
And so the thing that I would say to answer your question is you have to pay yourself first, Wesley. So, so if you're, you have to think about this. Unless you want to work forever and you don't care about leaving an inheritance to any of your heirs, you work and you take a portion of your income, 5 or 10%, and you set it aside. Firstly, you build up some emergency funds that are maybe 3 months income in case of a rainy day, or you get shellacked by COVID-19 or something like that.
Right.
And then you can get more aggressive with those monies, especially if you're younger. And so you set these monies aside, a retirement plan, an IRA, 401k, all those qualified plans are a wonderful place to begin because you have tax deferred compounding and you get a subtraction from your income. So you get tax benefits with that. But home ownership is another thing. Mm-hmm. I think for all those people that are out there renting,
right,
including yourself,
right,
you want to have, you spend all that money every month and it goes to a landlord and they gain the equity in the house.
Right.
So I think mortgage interest is tax deductible too, and mortgage rates are under 3%, the lowest they've ever been during my lifetime. So I would say for someone just getting started, you think about home ownership. Now this is, if you have credit cards or anything like that, those things need to be paid off first. But home ownership, emergency monies, and then saving a periodic sum of money on a weekly or monthly basis. That's called dollar cost averaging. It's actually magical. It ensures that over long periods of time, the average price that you pay for something is lower than the average cost. Mm-hmm. And it's a great way to accumulate. I had a guy a boom operator in the Air Force that started, way back in 1990 with $50 a month, and he eventually went to where he was just saving $200 a month. Well, he had an account with me that was over a couple $100,000.
Yeah.
So
and we've done that math.
Yeah.
When we've looked at it at $50 a week, if someone did about $50 a week for, because we used my age, and I'm 37, so $50 a week at 30 years, which puts you to about 67. That would roughly put you close to, if everything stays on course like it has according to history. That puts you roughly around what, 450K or something close to that or something.
Yeah, just doing $50 a month, I think.
Yeah.
So if you did $100 a month, it would be. I think I'd have to get I could check this very quickly with my calculator, but. Who's the motivational speaker guy? Tony Robbins.
Tony Robbins.
I think he said if you do 300, start at age 25, save, put $300 a month into the stock market for 8 years, then stop, then let it grow till you're 65 and you have $1 million.
Yeah.
I mean, that math is going to be pretty close. So the stock market historically has done 10% a year. Here's a rule for our viewers. It's called the rule of 72. Don't ask me how this works. It just works. If you take
now I want to ask.
If you take the number 72 and divide your percentage return into that number, it'll tell you how long it takes to double your money. So if you're making 10% a year, which is what the S&P 500 has done historically, for example, 10% divided into 72 is 7.2 years, you double your money. If you make 15% on your money, you double your money every 5 years. If you make 9% on your money, you double your money in 8 years. So, so that's a good kind of rule of thumb cut it with a meat axe way to think about it. If you invest in small company stocks, they've done 12.5% a year. You double your money every 6 years. So you do this, periodically, persistently, never giving up, and you can accumulate a large chunk of change by the time. And the sooner you get started, the sooner you can retire
Okay.
and reap the benefits of your efforts.
Let me ask you this. It's not on the pre questions that we kind of discussed. And so,
Okay,
and I understand that this is going to be a shotgun answer.
throw me a curveball, man. I'm ready.
I'm ready to. Would you tell somebody that's starting their career, they're day one, and you're sitting and you're filling out all the paperwork from HR, blah blah blah, and they present to you 401k. Would it better behoove them to do the 401k or bring someone like you into the equation? Because for a long time, our parents would be like, make sure you sign up for that 401k. You put into that 401k. But as far as the
That's a
average
really
return,
good question,
I
and
know.
I'll bet you that I'm going to give you an answer that you're not going to expect. In most cases, those people are going to be better off investing in their company 401k plan.
Okay.
And the reason is because most 401k plans, the we've managed 401k plans here, and it's a travesty when you have employees that don't participate in them, because most of them typically have a 5% matching contribution. So in other words, let's just say a guy makes 100,000 a year and he puts 5% of his income into his 401k plan. The company will match that up to 5% of his income. So that means if he puts $5,000 a year in there, the company's going to put $5,000 a year, and without even considering what he invested in, he's already made 100% on his money
Yeah.
because of the company match. And then that compounds tax deferred. You can accumulate a lot of money. There are many Americans that have $1 million 401k balances right now. So now here's another twist to that, though, Wesley. If you have a large 401k out there, I talked to someone last week that was telling me, I was letting them know that if you own an inherited IRA or you're over 70 and a half, the IRS has mandated a required minimum distribution. We call it an RMD, and or minimum required distribution, MRD, depending upon what firm you work for. That was waived this year because of COVID. So you don't have to take, it's generally the December 31 ending account value divided by your life expectancy, and the IRS takes the tables all the way up to age 115. At age 115, Wesley, if you live to be that old, you have to take half of the money out each year, until you die. So, I was talking to a gentleman though about his RMD. It was waived this year. He doesn't have to do it. And he says, I need to come in and see you. I've got this guy works for a company, a French company in town that makes roofing shingles,
Yeah.
and he's accumulated $700,000 in his 401k, and he wants to come in and have it reviewed. And here's what I told him. A lot of these 401k plans have a self-directed option,
Yeah.
and you can hire us to manage that for you. Typically, a 401k has a menu of a dozen choices, and oftentimes they're not the best choices. And sometimes they're horrific choices. And in a few extreme instances, we would say, don't do that. Come to us. We'll show you something else. But most of the time, the 401k path is the path to take. And we can actually help you invest those monies as well.
I think you're right. That is definitely an answer I was not expecting. Um, but I think that's a great answer. I think that's a great alternative. Having worked for different companies and ones being, having ties into other investment firms and things of that nature. It was mandated that I participate in the 401k, but they also did a 100% match. And so
Oh, cool.
whatever I put in, they put in.
Oh, that's awesome.
And I love that, you know. And so, but I think this was very informative. I think people are going to get a lot out of this.
Yeah.
And so,
Well, you're our social media marketing guy, so you've got to work some magic on Facebook for us and get a few million people to watch this video and send us some money.
okay. So here's the deal: if you're watching this right now and you know people that are looking to do something with the money they have set aside, maybe it's just sitting there. I mean, you could literally let it sit there, but it doesn't accumulate you any interest or wealth. So what's the point? But why not reach out to Eagle Financial? And if you're watching this and you already are with Eagle Financial, you should be sharing this because you already know the benefits. So how's that for you?
That sounds fantastic, man. We need to put you on the payroll.
Yes. Where's my Christmas bonus?
Okay.
I'm looking for my holiday ham.
Okay. Well, it's Friday afternoon.
Yes.
Second round of the fantasy football playoffs.
I was wondering if you were going to mention football.
Yes. The Thursday night game, we had three. We made it, the dynamic duo, Stacy Ditt and myself. We were the champions last year of our fantasy league. This year, we made it through the first round at the end of the match. It came down to the last game. And Hunt, the tailback for because he played for Cleveland Browns, scored 2 touchdowns, and he saved the day for us. We won our first playoff match. So last night was a tough one. The Chargers taking charge in the end, but
no pun intended. Huh?
We've got LSU's playing their final game this Saturday. I think, right, Stacy? Correct. Who are they playing?
Is it Ole Miss or Mississippi?
Yeah, they're playing Ole Miss. That ought to be a thriller, especially given the performance of first-timer, their quarterback, rookie quarterback, first start ever, beat 6th-ranked Florida last week. So now we're looking to go to 5-5. That sounds like a horrific year, but LSU graduated so much after their national championship team last year. So we have Ole Miss. It's the last game of the year for them. They've already bowed out of a bowl season, it looks like, but it's conference championship week. Notre Dame and Clemson go at it for the second time. I'd be picking Clemson on that one. They still both may make the Final Four college football playoffs. Alabama looks like the best team to me right now. But in the NFL, big news for people from Louisiana. Drew Brees, after cracking 7 or 8 ribs, appears to be back, and he's going to be starting for the Saints, and we need him back there to get ready for the playoff run. Saints are 10-3. Drew is back. Who are they playing Sunday, Stacy?
They're playing the Chiefs.
Oh, we've got the Chiefs. Patrick Mahomes coming to the Dome. Is that right?
I can't remember where they're
We
playing.
can't remember whether it's home or away. But that's a wrap from the Jack and Bill Show featuring Wesley Roderick this week. And we'll see you next week. Make good decisions. Have a great weekend. Stay warm and dry. Peace out.